Hello there, I'm Laura Kyle. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, Britain is again cutting taxes for workers ahead of elections. But can the Conservative government's budget for 2024 win over voters? Surprise overhauls in cash-strapped Egypt, followed by billions of dollars in loans and foreign investments. Will they help shore up the economy? And Bitcoin is rocketing. What's behind the surging price of the digital coin? And is the cryptocurrency industry making a comeback? Britain slipped into recession late last year. Many people and businesses are struggling with a high cost of living. The Conservative Party is battling for its electoral future against a bleak economic backdrop. The spring budget of 2024 was seen as an opportunity for Chancellor Jeremy Hunt to offer voters some sweeteners. The Conservative government is trailing Labour in the polls, but is a second tax cut in 4 months enough to shift the political dial? Well, we'll get to that with our guest in just a moment. First, this report from Harry Fawcett in London.
Is this an election-winning budget, Chancellor?
For Britain's governing Conservatives, trailing by double digits in the polls, this month's budget needed to be a momentum shifter, a vote getter.
From April the 6th, employee national insurance will be cut by another 2p from 10% to 8%.
The headline measure was a cut in national insurance contributions, estimated to save the average employee nearly $600 a year, paid for by co-opting an opposition Labour Party policy, ending a tax break for those domiciled for tax purposes outside of the UK. As the Prime Minister went to sell it to voters, analysis showed the overall tax burden, already at its highest rate since World War II, would continue to grow. One post-budget poll saw Labour extend its lead.
I guess it wasn't unexpected. There were some things that were quite pleasing at the child benefit.
I am complete Tory, but quite frankly, I think they've had their time and they need to get out now.
I think it's just a bit of political speak that he's using to promote himself during a difficult time for the challenges that are facing the government.
There's also been criticism from the government's fiscal watchdog, still unclear on potentially competing commitments to increase some public spending while reducing taxes and the size of the national debt.
We know the government's plans for national insurance. We know the government's plans for energy taxation in 5 years' time. But what we know about government's plans for spending on public services runs out after March of next year.
By March next year, though, most observers expect the Conservatives to be out of power. Labour is projected to win a comfortable majority. Even in office, though, Labour will have constraints, especially now the Conservatives have spent money Labour was intending to spend elsewhere on this national insurance cut. One left-leaning think tank says it's time a bolder approach was taken, either borrowing or raising tax to invest.
You cannot cut your way out of a crisis. And so what we need instead is for them to spend their way out of the crisis. And there are ways to achieve that, so long as they don't box themselves in with arbitrary fiscal rules.
Polls suggest the National Health Service and the cost of living top voters' concerns territory Labour will look to occupy when the campaign proper gets underway. Harry Fawcett, Al Jazeera for Counting the Cost, London.
Well, joining us now from London is Freya Beamish. She's Chief Economist at Global Data Lombard. Great to have you with us here on Counting the Cost, Freya. So what do you make of this budget? We've got a second cut in months to national insurance tax. That's paid by workers. But how much difference will it actually make to workers, to the economy and ultimately to the Conservatives?
Well, at this stage, inflation is coming down, so real incomes should start to improve. But there has been a very tight position for workers for some time now, and so tax cuts in a way help. But to me, it's looking in the wrong direction. This whole budget has been dominated, as the previous budgets in recent years, by this discussion of fiscal rules, which seems really more of a false dichotomy, that's a constraint that the government has almost unnecessarily imposed on itself. Not to say that there shouldn't be any kind of fiscal rules and management, but the type of fiscal rule focusing on trying to bring down debt to GDP over a 5-year period or by a 5-year period, it's a sort of the wrong starting place. Instead of focusing on trying to bring down debt to GDP, the question should be, okay, well, how can we improve GDP? And so instead of being handed this sort of fiscal headroom, which the government has spent on kind of national insurance contribution cuts and some improvement attempts to improve productivity in the NHS. The question should be kind of can we go further than just trying to rehash these attempts to improve productivity and look at the fact that real spending per capita is still going to be falling in a backdrop where there is already a dire need for spending in justice, health, education across the board, and that would actually create the type of environment in which businesses could flourish.
So actually, just to jump in there, you essentially agree with the analyst in Harry's report that we should, or Britain should be spending more rather than cutting back, despite the spiralling debt.
The government sort of got itself into this nasty sort of self-fulfilling prophecy, which is almost institutionalized at this stage, and the Bank of England is a part of that as well, whereby the Office of Budget Responsibility will hand the government a weak growth forecast. And then the government will say, oh, well, we need to do something to constrain the deficit in that context, rather than recognizing that there is spending that needs to be done. Most obviously within the health sector, because there are 6.4 million people that are waiting for treatments. And the number of long-term sick people that can't work, and the government is therefore having to pay the welfare bill of these people, has risen very, very rapidly over the course of the past few years. So making that spending to raise per capita investment in healthcare makes absolute sense, and it's a complete false economy to fail to make that spending.
We've got a general election coming up at some point this year. Do you think the current opposition party, the Labour Party, which many predict will get into power, will take that approach to the economy?
I think, given the recent history, the worry is that the shock that was sent through markets by the attempt of Truss and Kwarteng to transition in a completely inept way, in my opinion, to a growth policy rather than a debt-focused policy, that has now put policymakers on the back foot, and they're now worrying about, they have to be fiscally sensible again and trying to stick to these fiscal rules. Before Labour gets into power, it's assuming that that's the direction that is going to unfold. It seems unlikely that they'll therefore come out and kind of say anything that would rock the boat in that sense. But I think my expectation is, given the sort of the clear spending that needs to be done, that there might be some transition in the nature of fiscal rules. For instance, taking investment out of that kind of fiscal rule over a kind of 5-year period, so that the government can make necessary investments without feeling it's hitting up against its fiscal headroom.
Just briefly, Freya, we saw the UK economy growing by 0.2% in January. That was after it sank into recession at the end of last year. Is it turning a corner? Is the outlook looking brighter?
Certainly, the leading indicators for a kind of a 3 to 6 month outlook look better for the UK and actually across Europe. So that's a positive sign. Especially inflation is coming down relatively quickly, but wage growth has remained reasonably kind of sticky, and it will probably start to decelerate. Wages will probably start to decelerate. But what that leaves us with is the part of the cycle where real wage growth starts to come through, and essentially the part of the cycle where the working population, workers, actually get their share of the pie over the past cycle. That tends to be in a kind of a capitalist economy when that happens. So that's a kind of a positive. The negative, unfortunately, is that policy is still far too tight, both in terms of fiscal and in terms of monetary policy, and so that's a drag against that.
Freya Beamish, very good indeed to speak to you. Thanks so much for taking the time to join us here on Counting the Cost. Now, soaring inflation and a severe shortage of foreign currency are hitting Egypt. The economic crisis has been worsened by the war on Gaza, and the Middle East nation has come close to defaulting on its debts if it doesn't make financial reforms to attract investors. So the government has delivered its biggest ever hike in interest rates and allowed its currency to float. These measures have released more than $40 billion in investments and loans from the United Arab Emirates and the International Monetary Fund. And more could be on their way. Victoria Gatenby reports.
The Egyptian pound has had a problem for years in that not many Egyptians want it. They prefer to have US dollars. Many believe that currency is a lot more stable. But Egypt's reserves of dollars have been running out, and the gap between official and black market exchange rates has been huge. Now the government is allowing the Egyptian pound to trade freely on the foreign exchange markets. It's part of a deal with the International Monetary Fund to lend Egypt around $8 billion. Observers say deregulation has been made possible in part by a recent announcement by the UAE to invest $35 billion developing the Ras Al Hikma Peninsula on Egypt's Mediterranean coast.
I have an approximate rate of 45 to 50 Egyptian pounds to the dollar after getting money for the Ras Al Hikma project, as well as funds from the IMF and the European Union. Now we can achieve a flexible exchange rate determined by demand.
Egypt has devalued its currency 3 times since 2022, but has maintained controls to fix its exchange rate. Its decision is the first time the currency will be determined by the free market.
It's a long time coming. The Egyptian people have anticipated this, and investors have been putting pressure on the government to actually do this to narrow the divergence between the official and black market rates.
Within minutes of the announcement, the Egyptian pound sank against the US dollar to a record low. Many Egyptians say it's making life unbearable.
Is everything in our life linked to the US dollar? What happened to the Egyptian pound? It is worthless now. A 10,000 Egyptian pound salary is no longer enough for a family in a month.
Egypt's economic crisis, made worse by the coronavirus pandemic and Russia's invasion of Ukraine, has been further exacerbated by the war on Gaza. So much so, the IMF has agreed to accelerate the loan process.
The most direct impact is from the Suez Canal. They used to collect $700 million per month from revenues. Now, traffic is down by 55–60%.
Freeing the Egyptian pound may be welcomed by international investors, but Egyptians are likely to face more hardship, at least in the short term. Victoria Gatenby, Al Jazeera, for Counting the Cost.
Well, here's a quick look at other countries the IMF has approved loans for in the past year. Pakistan got $3 billion. That helped prevent the country defaulting on its debts amid soaring inflation. $2.9 billion went to Sri Lanka to rescue its battered economy. The government implemented spending cuts and tax hikes to secure IMF support. And earlier this year, the IMF agreed to a $4.7 billion loan for Argentina. Inflation there has reached 160%, and 40% of the population are living in poverty. Well, let's go now to Egypt and speak to Medad Nafer. He is a professor of economics at Cairo and Nile Universities. Great to have you with us. So the IMF's $8 billion loan to Egypt, it's huge. Why has it and the UAE been so quick to aid Egypt's potential recovery?
Good day, and thank you. Thank you very much for having me on the show. First of all, we have to repeat what has been repeated in the media, that it is too big to fail, and too big to fail because of what is happening in the region. It's very important to see it from this lens, using this lens, because Egypt is very important to the region for the stability, and also to counter some of the immigrations to Europe and to other part of the White Sea, the Mediterranean, and also because Egypt is suffering now more than ever, especially after the cascading crises, starting from the COVID-19 and then to Ukraine-Russian war, and now the Gaza war.
Is this going to be the rescue that's going to save it, though? Or is it still at risk of failing?
Yeah, of course, we don't have actually the risk of failing. We had a problem with and issues with liquidity. And with monetary tightening, and with fiscal austerity that we are looking forward, actually, we can contain the hyperinflation, which is the first enemy to the people. After containing the hyperinflation, we can restore the remittances, we can restore the capital flows from abroad. Most of the cash flows are essential for the Egyptian economy. Actually, our ratio, or our saving ratio of saving rates is from 6 to 8% of the GDP, and it is not enough to sustain any growth of GDP from 6 to 8% that is anticipated. So unless we fill this gap with foreign investments, like hopefully foreign direct investments are not in debt or any hot money, we cannot survive with such burdens and such new challenges.
Now, Egypt, for the first time, has had its pound valued by the free market. It lost more than 60% of that value within hours of flotation. That was disastrous for many people in Egypt. What is the likelihood of it stabilising?
Well, actually, I cannot call it a free-floating. We cannot have a free-floating. Even Milton Friedman himself said some countries, like Chile, cannot have the free-floating regime. We can be lucky if we have the soft-pegged regime, and this soft-pegged needs liquidity in order to be soft, in order to have some flexibility. So whenever we receive we have good buffer to defend the new rate. We can have such devaluation. And devaluation this time was very important because, you know, the gap between the parallel market and the official rate was huge. So we had to go this way, and also to counter the foreign currency crunch, which was agony. It was actually passed through to the inflation in a very bad way. You know, most of our imports are strategic, so we don't have any elastic imports. We don't have any elasticity dealing with imports. 75% are strategic goods and raw materials. And actually, we import like double what we export. That's why we have, this is a chronic disease. This is a disease that we must look at. The deficit, the twin deficits, actually, external and internal deficit. Everything else is are symptoms. The currency crunch, even the hyperinflation, it is they are all symptoms for the very specific disease that we all know, the big elephant in the room, which is the deficit, the twin deficit. We keep fueling this deficit by having mega projects, by having white elephant projects. We kept fueling them for long, and we kept fueling them actually by having the external debt reaching $165 billion. So we became very near to a solvency issue we didn't have before.
Okay. Nearly 30% of Egyptians are living in poverty. It is a huge number. How long before they start feeling some of the benefits of these reforms?
I believe they were suffering from the hyperinflation very badly. So the monetary tightening and the relatively loosened control on the US dollar will try to tackle both sides of inflation, the supply side driven and the demand side. Demand side by absorbing the excess liquidity, and the supply side by availing the necessary goods. As I said, we had backlog of goods in the ports that we cannot afford to get into without the availability of the US dollar. So this shortage in commodities reflected directly and passed through directly to inflation, and having the inflation reaching tops like 40% a year, and this is the formal one, the official one, I mean. So I believe that in the short term they might suffer even more because of the some goods were imported with using the old controlled rate, the 30 per dollar, but now it will move a little bit. Yes, this may be offset a little bit by having more commodities available in the market, so that the market stabilize again with some sort of competition that makes prices a little bit lower.
Medhat Nafer, we do have to leave it there, but great to speak to you. Thanks for joining us.
Thank you.
Now, young people in South Africa are bearing the brunt of the country's highest unemployment rate on record. 40% of people under the age of 34 are out of work. Famida Miller has more from the Northwest Province.
1 in 3 South Africans are unemployed. And those between the ages of 15 and 34 make up 40% of those without jobs. That's 4.6 million people. Tlhabanyane Ramoatle and his friends live and grew up in the township of Mokwasi in the Northwest Province. They've not had steady work for years.
I was exposed to IT in high school. So post leaving high school, I started dabbling with a bit of IT courses here and there offline from Udemy. So I kind of understand a bit of coding and software development. But finding employment has been quite difficult. I think the last employment I had was sometime last year.
For me, it's difficult because I have to look up for me, family. So it's difficult for me because I don't have financial, I don't know what to call a financial background or something to help me. And there's no work, there's no opportunities.
According to the World Bank, South Africa has one of the highest levels of inequality in the world, with more than half of the population living in poverty. And a worsening economy is making their lives even more difficult. Rolling power outages, crumbling infrastructure and corruption have negatively affected investment and economic growth.
This is an election year for South Africa. During its manifesto launch, the governing African National Congress promised to create 2.5 million jobs over the next 5 years. Critics say, despite being in power for 3 decades, the ANC hasn't managed the economy effectively, and even more people are now unemployed.
The government is encouraging people to open their own businesses, especially those living in rural and outside urban areas. Mpemetse Depatala says he's been trying to start his own business, but hasn't had much luck, nor help from government officials. Others blame government failures.
It's not easy to get funding these days because there are corruptions, or they don't get back to you, just keeping you on hold. So that's a little bit challenging.
While these young men say they need to earn an income to support themselves and their families, they say daily work is just as important for their dignity too. Famida Miller, Al Jazeera for Counting the Cost, Northwest Province, South Africa.
Bitcoin lost more than 60% of its value in 2022. The cryptocurrency market shrank by more than $2 trillion that year. The volatile Bitcoin was pronounced dead by many observers, but the king of crypto is once again winning over investors, breaking earlier records when the industry was booming. Last week, the digital currency hit a high of more than $72,000. Its previous record was just under $69,000 in November 2021. Prices crashed to below $20,000 in 2022 after several major crypto companies went bankrupt. Well, joining us now from Dubai is Jamil Ahmad, a chief analyst at GTC Group. That's an online trading brokerage. Great to have you with us. I mean, Bitcoin's had quite the journey, hasn't it? Tell us a bit more about why we've had this resurgence now.
Bitcoin, it's sizzling in the pan, and this pan is very hot. We've had now 4 successive days of all-time highs. We've now broken $73,000 as of the past 24 hours. Generally speaking, crypto fever is very much back. If you look at the price chart, we've more than doubled price over the past 6 months. And essentially, there's 2 different factors at play here. Number one, that ETF product's finally being approved. That was what led the rally that started in October time, where Bitcoin was up by just above $30,000. That ETF product from the US securities regulator, that essentially meant that institutional money, which is very serious investor money and that capital, was starting to now be attracted to cryptocurrencies. That was a major draw. And secondly, we have halving, which is a technical term, but that's set to take place in April. And that's seen as reducing the amount of coins that are going to be in circulation. And then you have a supply and demand factor at play. Right now, certainly is a buyer's market. So the less demand the more demand you have for Bitcoin and the less supply you have if this halving does take place. That's also pushing price up as well.
Okay. I mean, it's interesting, isn't it, that Bitcoin was originally created to bypass existing financial institutions, and yet now we have the arrival of institutional investors helping to fuel its rise.
That's completely correct. Look, Bitcoin used to be seen as a millennial investor sentiment. It used to be seen as for Generation Z. What you're seeing now with the institutional money, these are the real asset managers, the real financial players that dominate the financial landscape. Now Bitcoin's very much saying that we've been here for 10 years or so, we're still here, and now we're here to play where the big boys play. And that's what you see with the institutions now flowing money into Bitcoin, cryptocurrencies. We've had more than $4 billion of inflows in dollars just in the first 1 month of the exchange-traded fund product. That is a very serious product, and that shows the institutional money, which is backed by the major financial players, they are now starting to lean into cryptocurrencies as well.
So with all this excitement surrounding Bitcoin, is it a good idea for the average investor to put their money into it?
If you look at the chart, they say a picture says 1,000 words. Quite clearly now it's a buyer's market, but of course you have to say to the everyday person on the street and the everyday person that you never invest anything more than you're potentially prepared to lose. Because although it might be very much a summer season for Bitcoin in 2023, we had this in 2021 where Bitcoin moved more than 61% over a couple of months. You already mentioned in the intro that was the previous all-time high of November of 2021. It then lost more than it gained in 2022. Before that rally then resumed into late 2023. So as for any investments, any type of investment asset classes as well, what comes up might come down, and all investments are fluid and they can move in either price direction. But right now, yes, clearly, with the price moving more than $20,000 over just the past 1 week, quite clearly now the signals there that it's a buyer's sentiment market. But of course, seasons change.
Indeed, they do. Only prepared to put in what you're prepared to lose. Great advice, Jamil Ahmed. Many thanks for joining us on Counting the Cost. And that is our show for this week. But remember, you can always get in touch with us via Twitter. Use the hashtag AJCTC when you do. Or drop us an email. countingthecost@aljazeera.net is our address. And there's plenty more for you online at aljazeera.com/CTC. That'll take you straight to our page with individual reports, links, and all the back episodes for you to catch up on. Well, that's it from us at Counting the Cost for now. I'm Laura Kyle, and from the whole team here, thanks for joining us. The news on Al Jazeera is next.